Millions out of work weekly. How do we track it? How do we track such an event? The answer lies in initial unemployment claims data, which records the number of individuals applying for unemployment insurance benefits for the first time. This metric provides early indicators of economic trends and job market health. Every Monday morning, state labor departments in the United States process a large number of phone calls and online applications from workers who have lost their jobs. These are unemployment claims. In a healthy economy, the level of these claims tends to remain relatively low. However, when unemployment claims suddenly increase, it often signals potential issues or downturns in the economy. Here's the key. Changes in unemployment claims, even small percentages, can represent millions of people entering or leaving the workforce. Let's take a closer look at how this works and why it matters so much for understanding economic health. Understanding unemployment claims: when you lose your job through no fault of your own, you're generally eligible to apply for unemployment benefits. The application process typically involves submitting an application online or by phone, where you'll need to provide information such as your employment history, dates of employment, social security number, and the reasons for your job loss. It sounds straightforward, but each state has distinct rules and procedures for processing unemployment claims. For example, in California, it can often take several weeks to process a claim. This complexity increases significantly during an economic downturn as thousands of people file claims simultaneously, making the situation more challenging. How unemployment claims work: think about it like this. Every Monday morning is crunch time for labor offices as they process a wave of new applications from laid-off workers across the state. When more than 300,000 people file claims in 1 week, whether you're talking New York or Texas, that's an immediate sign of trouble in the economy. Let's look at numbers from the past. In March 2020, when the pandemic hit, weekly unemployment claims surged to over 3 million. That's a massive jump from the typical range of around 225,000 claims per week prior to the pandemic. It's like going from steady rain to sudden flood. Why unemployment claims matter: unemployment claims aren't just about tracking job losses. They're a real-time economic indicator that reveals the health of the labor market. They show how quickly jobs are being lost and whether companies are laying off workers en masse. This data is crucial because it helps policymakers decide when to implement relief measures such as stimulus checks or unemployment extensions, but it does not provide specific guidance on what actions individuals should take with their investments or finances. For example, during the 2008 to 2009 financial crisis, initial unemployment claims frequently surpassed 600,000 for several weeks, peaking at over 1 million claims in some instances. This trend indicates significant economic distress and highlights the need for timely policy intervention. Without such metrics, policymakers would lack crucial data to assess the health of the labor market and overall economy accurately. The bigger picture: so why should you care about the weekly reports on Friday mornings? Because unemployment claims provide a clear snapshot of economic health. Higher claim numbers indicate more people are losing their jobs and thus have reduced income, leading to decreased spending on essentials like groceries, rent, or fuel. Let's say the average person loses their job and files a claim worth around $375 per week in benefits. If 1 million people file claims, that's $375 million in lost wages each week. Multiply that over several weeks or months, and you can see how quickly this adds up to billions of dollars missing from the economy. The impact on your money: here's a concrete example. Imagine you're one of the many individuals experiencing unemployment. Suddenly, your regular income ceases, but your expenses continue. You might rely on savings or credit cards to cover these costs. Over time, this situation can lead to financial strain and potential debt accumulation. But it's not just individuals who suffer. Small businesses depend on consistent consumer spending to remain viable. When there are fewer employed individuals, there are also fewer customers able to spend money, leading to further job cuts and potential closures at these small businesses. This creates a harmful cycle that affects the broader economy. The role of government relief: governments respond to these claims by providing relief packages designed to cushion the economic impact on individuals. For example, in 2021, stimulus checks were issued to help millions of people facing job loss. However, delays and administrative hurdles can exacerbate financial strain. When individuals wait weeks or months for benefits, they're more likely to experience deeper financial difficulties. This is why quick action by policymakers matters. It's not just about the money, it's about timing. Swift intervention can help mitigate the economic damage caused by high unemployment claims, supporting those affected and helping to stabilize the broader economy. The long-term consequences: unemployment not only impacts your current income but also affects your future earning potential. Prolonged unemployment can result in skill deterioration and limited job prospects, making it more difficult to secure stable employment in the future. Consider the 1981 to 1982 recession, when unemployment rates reached double digits. Those who were laid off during that period faced lasting effects on their careers, including higher barriers to re-entering the workforce and lower income levels for years afterward. This highlights why understanding economic trends early can be crucial in planning your financial future. The real-time data unemployment claims aren't just historical data points. They reflect current economic conditions. Each week, particularly on Wednesday when new claims data is released, we get a glimpse into the health of the labor market in real time. This data acts as a vital sign for economists and policymakers, offering insights into job stability and economic trends. If we observe a surge in unemployment claims, it indicates that people across the country are filing for jobless benefits at an increased rate, which can signal broader layoffs and economic challenges. This data helps economists and policymakers anticipate potential economic downturns and plan accordingly. Visualizing the impact, let's take a concrete example. Imagine two lines on a graph. One line represents initial weekly unemployment claims, and the other shows job openings reported by employers. Typically, when unemployment claims rise sharply, it often indicates increasing layoffs or economic stress, which can lead to a decrease in job openings as companies become more cautious about hiring. This dynamic reflects the tension between economic stability and instability. For instance, if we observe a sudden spike in unemployment claims without a corresponding increase in job listings or hiring activity, it can be a clear indicator of economic strain. This kind of data helps us understand potential economic challenges and the need to prepare financially for more difficult times ahead. Your role as an individual, so what can you do? First, keep track of your finances and have an emergency fund ready. An emergency fund is money set aside specifically for unexpected events like job loss or medical emergencies. This buffer helps you manage financial hardships without relying on debt. Secondly, stay informed about economic trends by following reliable sources that provide updates on unemployment claims and broader economic indicators. Understanding these developments can help you make more informed financial decisions. The hidden cost of high unemployment claims. Now here's an important truth. High unemployment claims can have significant negative impacts on the economy. When people lose their jobs, this leads to a chain reaction affecting various sectors. Small businesses may struggle due to reduced customer spending, which in turn decreases overall consumer demand and slows economic growth. For example, during major downturns like the Great Recession or the COVID-19 pandemic, millions of people lost their jobs and filed for unemployment benefits, significantly affecting various industries. Retailers experienced decreased sales, restaurants faced challenges staying open, and construction projects slowed down. Understanding these unemployment trends can provide valuable insights into economic conditions and help individuals plan their financial futures accordingly. The boring truth about unemployment claims: here's something often overlooked. While high unemployment claims can signal economic distress, they also underscore the importance of robust safety nets and social support systems. Just as a car requires regular maintenance to prevent breakdowns, economies benefit from proactive measures that help keep workers employed and consumer spending stable. This might not be as exciting as day trading or speculative investments, but it's crucial for understanding long-term economic trends. Staying informed about unemployment claims can help you better understand and prepare for shifts in the economy without relying on flashy get-rich-quick schemes. Your money, your future. So here's what to remember. Unemployment claims provide a real-time snapshot of the current state of our economy. Rising claims often indicate an increase in job losses and financial stress for individuals, which can signal broader economic challenges affecting many people. By staying informed about these trends, you're better equipped to understand and prepare for potential changes in the economic landscape. In short, high unemployment claims indicate that many people are losing their jobs quickly. Understanding this data can help you prepare for economic uncertainty and safeguard your finances. This is educational and historical, not financial advice. When unemployment claims spike, it's a red flag for economic slowdowns or recessions. Remember, these numbers aren't just abstract figures. They represent real people and their livelihoods. For instance, during the 2008 to 2009 financial crisis, weekly initial unemployment claims surged from around 300,000 to over 651,000 in a matter of months. Knowing this data is like having an early warning system for your finances. It's not about predicting the future, but rather understanding what's happening now and preparing accordingly. For example, if you see claims rising steadily, it might be prudent to review your emergency fund or consider cutting back on non-essential spending as part of a broader financial preparedness strategy. Think about this, every unemployment claim represents someone who may need additional support from government programs or financial safety nets. This surge in demand can strain resources, leading to delays in benefits and increased hardship for those already struggling. Understanding these trends can help you adjust your own financial strategy early, preparing for potential economic changes without the need for last-minute actions. High unemployment claims indicate potential shifts in industries and job markets. This information can be useful for understanding broader economic changes and making informed career or educational choices. For instance, if manufacturing jobs are declining while tech positions remain stable, this data can help individuals assess which sectors may offer more promising employment opportunities. However, it's important to note that such trends should inform education and skill development decisions rather than direct investment choices. Understanding these shifts helps individuals make smarter long-term plans for their careers and financial futures. This is educational and historical, not financial advice.